Yo, what's up everyone? Welcome back. Patrick here, moving on to another example dealing with manufacturing costs. So as usual, this example, it's written out in the lecture notes. You'll find them there. You don't have to write all of this out. You could print those lecture notes out, and this example will be written there for you. And what we're dealing with here is we have this company, ABC Incorporated, and during 2009, we're told that they made 50,000 units of a product and then sold each unit for $120. Each unit included the following costs. So these costs over here, so there was direct materials, direct labor, and then manufacturing overhead. And if you see the figures here, they're given on a per unit basis. So sometimes you'll be given these manufacturing costs as a total. A lot of times you'll be given them on a per unit basis. So notice, because these figures are so low, they're given on a per unit basis. And then we're also told that the total salary for the sales team was $300,000 plus a commission of $3 per unit. Other admin expenses totaled $200,000. There was no beginning or ending finished goods or work in process inventory. And we have to answer 3 questions. So number 1, we got to calculate the per unit and total product cost for 2019. And number 2, we're going to prepare an income statement for 2019. And then number 3 is going to be a little tricky. We're told that we're going to assume the same parameters that were given, but that the company had beginning finished goods of 5,000 units. So if you remember, there was no beginning finished goods before, but now we're going to assume that there are beginning finished goods of 5,000 units that were produced in 2018 at a cost of $70 per unit. And we're told that the company follows a FIFO policy, a first in, first out policy, and we have to prepare an income statement for 2019 given that new information. And then they're also asking, what if it follows a LIFO policy? So we will get to that. Let's focus on these first 2 questions. So number 1, we got to calculate the per unit and total product cost for 2019. This is actually going to be pretty easy. Basically, the product cost per unit, what's a product cost comprised of? Well, direct materials, direct labor, manufacturing overhead. And as I mentioned, those are on a per unit basis already, so we just have to add those. So 20 plus 60 plus 10 gives us $90. So that's the product cost per unit for 2019. Now the total product cost, what's that going to be? Well, it's going to be the total product cost per unit, the $90, times the number of units that were produced. And we're told that there was 50,000 units of a product produced, right? ABC Incorporated made or produced 50,000 units of a product. And then they took those 50,000 and they sold each of them as well. So there was no inventory left over. That's going to be important when we're creating the income statement. So basically, the total product cost was $90 times the 50,000. Right? And when you multiply those, you would end up getting 4,500,000. Right? That there is the total product cost for 2019. Now what we have to do in number 2 is we have to prepare an income statement for 2019. And actually, before preparing the income statement, what I want to do is go into a little bit more detail with that manufacturing flow chart. Okay, now you don't have to necessarily, but because this is still one of the beginning examples, I kind of want to go into a little bit more detail before we prepare this income statement. Now, if you remember from the manufacturing flow chart, the first line is the raw materials, but notice we're not really given too much specific information about the raw materials besides the direct materials used per unit, that's $20, but the direct materials used, we calculate that in the first line, but then that flows to the second line. Now the second line is what? It's basically beginning, work in process, so inventory that's being worked on, hasn't been finished yet, it's not available for sale yet, but it's still still being worked on. And then we have the direct materials used, plus the direct labor plus the manufacturing overhead. And then what happens is a portion of this becomes complete and it becomes cost of goods manufactured. So we take out those finished goods and then that flows into the finished goods inventory, and then we're left with ending work in process. But in this particular example, if you remember, we're told that the beginning work in process is 0. There's no beginning work in process, and there's no ending work in process. We're also told the same thing about the finished goods inventory. And so basically, whatever this ends up being, then that's also the cost of goods manufactured, because this is 0 here and then this is 0. So basically this here, when we add these three up, all of this has to net out to 0 in order for this equation to hold. So the direct materials used, $20 per unit, times the 50,000 units that were produced, right? And so when we multiply that, we would end up getting what? 1 million there? Right? 50,000 times 20 gives us 1 million. The direct labor was 60 times 50,000, which would give us 3 million. And then the manufacturing overhead, $10 times 50,000, and that gives us 500,000. Right, and then we have this 0 here, we're adding that. Then the cost of goods manufactured, let's put an X there, and then the ending work in process we know is 0. We're told there's no ending work in process. And so when we solve for this X here, it actually ends up being that total product cost of 4.5 million. Okay, so the way I'm showing it, it's kind of intense. I'm going really into detail with that manufacturing flow chart. In fact, when you're given a question like this, if a prof was going to go through it, they wouldn't go into as much detail here, but I really want you to understand what's happening in terms of that flow chart. So it might be a little bit overkill what I'm doing right now, but I feel like it's going to help you process better, give you a better understanding overall of what is happening, right? So that cost of goods manufactured is the same as that total product cost because there was no beginning or ending work in process. And then that flows to the next line on that flow chart where we're dealing with finished goods. So we have beginning finished goods plus that cost of goods manufactured, which is the 4.5 million. And then from that, what's going to happen is, let's not write an X yet. A portion of that, these are all finished goods here, a portion of those finished goods are going to be sold. That's going to be the cost of goods sold. And then we're going to have ending finished goods that are going to flow into the next period. But we're told there's no beginning finished goods, there's no ending finished goods, right? This is 0, and then this is 0. And so the same thing, basically the cost of goods manufactured, which is this 4.5 million, has to equal the cost of goods sold, because this has to net out to 0 because these numbers are 0. Now in number 3, what's going to be different is that this number is not going to be 0 anymore. We're going to have beginning finished goods, and because that company is going to be following a FIFO policy, it's going to affect this cost of goods sold, so the income statement is going to change for number 3. But for number 2, this is 0, this is 0, and so basically that cost of goods sold, right, when we isolate for this X, is just equal to the 4.5 million. So the product cost was 4.5 million, and then the cost of goods manufactured was 4.5 million, and then the cost of goods sold was 4.5 million. So flowed through, that number flowed through the whole way because we had 0 over here on each end for the work in process, and then 0 over here for the finished goods inventory. Right? So this here now, this 4.5 million is going to flow onto the income statement. And so to put in a proper format, we're going to have ABC Incorporated. So we'll have the title up here. Then we'll have the income statement. And remember, an income statement is for a period of time. So the period we're looking at is 2019, which is a whole year. So we'll say over here, year ended, or you could put for year 2019. All right, so first thing we start with on the income statement is the sales or the revenue. Now we're told that 50,000 units of the product are sold. Not only 50,000 are produced, but it's also that amount is sold. And so we're selling each unit for $120. So basically 50,000 times 120, that would give us 6 million. So that's going to be the total revenue for 2019. Then we have the cost of goods sold. Now the cost of goods sold is that 4.5 million that we calculated before. So that's going to go over here. We're going to be subtracting that amount, so let's actually put it in brackets. And then sales minus cost of goods sold is the gross margin. And so 6 million minus 4.5 million, that gives us 1.5 million. And then from there, what we want to do is we want to subtract periodic costs or periodic expenses. And that's like selling and admin expenses, and we were given information about that. So we were told that the sales team was paid a salary of 300,000. Let's actually write it on the side here. So we got 300,000. Plus they were paid a commission of $3 per unit. And then we were also told that other admin or general admin expenses was 200,000. So we have to incorporate those three things on the income statement because they're periodic costs. So we're going to subtract the sales salary. Now, you know what? I'm actually going to write this as a fixed. Let's actually put it over here. So we'll have fixed selling expense. You could write sales salary if you want. We're going to talk more about fixed versus variable costs in a future unit, but I thought that maybe this would be a good introduction. If you think about it, the salary for the sales team is a fixed cost. And we're going to see you can actually have fixed and variable manufacturing costs. You could also have fixed and variable periodic costs. So that salary is like a fixed selling expense. So that's going to be 300,000. Again, this wording here can be different, right? It can be in an example in a textbook. Maybe this will be just sales salary. It'll be 300,000. I'm going to write fixed selling expense. And then the commission, instead of writing sales commission, I'm going to write that's a variable cost if you think about it, because it depends on the number of units that's being sold. So I'm going to write a variable selling expense. So that's going to be the $3 times the 50,000, which would give us 150,000. All right, and then from there, we're also given that general admin. So I'll call it, yeah, just why not general admin or other admin. So the general admin was 200,000. And these are all expenses, right? So we're subtracting all of these here. And then what we would end up having, we can call this maybe net income. Usually net income, we have to subtract taxes and stuff like that. Any sort of interest as well. In this case, what I'm going to call it is operating income. Again, you might see different words here being used in different textbooks. I'll call it operating income or operating profit. And basically, we'll have the 1.5 million minus all of these, minus the 300,000, minus the 150,000, minus the 200,000. If you sum up all of these, we would end up having 650,000. 1.5 million minus 650,000 gives us 850,000. And so that there ends up being the income statement for number 2. So really the most work I feel like was getting that cost of goods sold. In fact, it wasn't as much work because this was the product cost, which was the same as the cost of goods manufactured, same as cost of goods sold. But if you're going through that flow chart properly, then it takes a little bit of time to come up with that number. Now, number 3, we're told to assume the exact same parameters that are given here, but we're told that the finished goods, there was a beginning finished goods of 5,000 units that were produced in 2018 at a cost of $70 per unit. So that's the product cost per unit from 2018. So the product cost per unit, if you remember in number 1, we calculated for 2019, it was $90. In 2018, it's going to be $70 per unit for these 5,000 units. So basically everything's going to be the same here, except this cost of goods sold. And in fact, the reason why this is going to be different is because the company is following a FIFO policy. So I'm actually going to, I'm going to work with all of this new information up here, and then I'll just adjust that cost of goods sold, because that's the only thing that's going to change on the income statement. Actually, before getting into the FIFO, let's you know what, let's first write out that beginning that finished goods line on the manufacturing flow chart. So we have beginning finished goods, then we had that cost of goods manufactured, and then from that, we're going to have cost of goods sold, and then we're going to have ending finished goods. Now, this line over here in that manufacturing flow chart, you can actually look at this stuff in 2 different perspectives. You could look at it in dollar terms, which is what we've mostly been doing up until this point. But you can also look at this with the number of units. All right, and this is what's going to be important when we're differentiating between the FIFO versus the LIFO policy. So check this out. Basically, the beginning finished goods, if we look at it from the number of units perspective, we're told that the beginning finished goods, there was 5,000 units. Let's not worry about the dollar terms for now. Let's just worry about the units. So we had 5,000 units of beginning finished goods. Then we were told there was 50,000 units that were produced. Okay, and then we were told there was 50,000 units that were sold, right? The number of units produced and the number of units sold was the same thing. And then we had ending finished goods. So if we take 5,000 plus 50,000 minus 50,000, we would end up having 5,000 units in finished goods. However, the actual units changes depending on whether it's FIFO or LIFO. So what I'm actually going to start with is LIFO. What if the company was following a LIFO policy? Then basically these units that were sold here, the units that were last put in to the inventory are the ones that come out. So it would actually be these 50,000 units. And if you remember, these 50,000 units, they had a product cost of $90 per unit. These units here have a product cost of $70 per unit. We're told that. And so if the company was following a LIFO policy, basically the units that would be sold would be these 50,000, right? The units that last came into inventory. Versus when it's going to be FIFO, then these 5,000 have to come out first, right? That gets sold, and then 45,000 of this. But if we're dealing with LIFO, then it's just these 50,000 units. And then if these 50,000 units are coming out, they have a unit cost of $90, then this cost of goods sold is still going to be the same. It's going to be that 4.5 million still, right? 50,000 times 90 gives us 4.5 million. So under a LIFO policy, even with this new information, the income statement is actually going to stay the same. That's why I wanted to start with the LIFO policy. But with the FIFO policy, it's going to be different because now that 50,000 units sold is going to be comprised of, with FIFO, what's happening is the units that were there first come out first. All right, so from that 50,000, we're going to have 5,000 units let's call these the 2018 units. Right? These have to come out first, and then 45,000 units of the 50,000 units that were produced in 2019 come out. Right? And these units have a product cost, a per unit cost of $70. So 70 times 5,000 gives us 350,000. And then what happens is these 45,000 units, these are the 2019 units, so they have a product cost per unit of $90. So we'll have 90 times 45,000, which gives us 4,050,000, like that. Right, when we multiply 45,000 by the 90. And so the sum of this and this here is going to be the cost of goods sold. And when we sum these two numbers up, we would end up getting 4,400,000 instead of the 4.5 million. So that's what's going to change with the FIFO policy. This is the FIFO. These have to come out first, and then 45,000 of these have to come out first. And so the ending finished goods is actually, the 5,000 units is going to be comprised of those 2019 units, which have a product cost of $90 per unit. With the LIFO policy, this ending finished goods was actually still these 2018 units, because these were the units that came out under the LIFO policy. But with the FIFO policy, the 5,000 units remaining are these ones, the 2019 units. Right, so just a little bit of review from financial accounting when we're dealing with LIFO versus FIFO. This can come up in managerial as well. So with the FIFO policy, what's going to be different is this cost of goods sold. It's going to be 4.4 million instead of the 4.5 million. And so this is going to change. This is going to be 1 million, the gross margin, and 600,000. And then this is going to be 950, that new operating income. So with the FIFO policy, with those 5,000 units of beginning finished goods, this here is the new income statement. All right, so thought this was a good example to tell you that these lines here, when you're dealing with that manufacturing flow chart, usually they're going to be in dollar terms. That's what we're going to be using it for, but they could also be in terms of the number of units. And when you get questions like this dealing with FIFO versus LIFO, then that number of units becomes important. That perspective becomes important. All right, so this is the income statement for number